Welcome to your Mortgage Minute. I'm Sarah, and today we're doing a deep dive on Blend and Extend, the strategy that could save you tens of thousands if you're renewing in 2026. Mouli, let's start with the core mechanics. How does a lender actually calculate a blended rate?
The formula is time-weighted averaging. Let's say you have 2 years remaining at 1.75% and you want to extend for 5 more years at today's 4% market rate. The lender calculates 2 years times 1.75% plus 5 years times 4% divided by 7 total years. That gives you roughly 3.18% blended.
So the more low-rate time you have left, the better your blend. Walk me through 3 different scenarios. Someone with 6 months left, 2 years left, and 3 years left on their term.
6 months remaining at 1.75%, extending 5 years at 4%, your blend lands around 3.9%. You're barely saving anything because there's minimal low rate time to blend. 2 years remaining, you'd get approximately 3.18%. That's meaningful savings. 3 years remaining at 1.75, extending 5 years, you might see 2.85%. The math gets progressively better the more time you have left.
Give me the dollar impact on each of those scenarios for a $600,000 mortgage.
6 months left, blending to 3.9%. Monthly payment around $3,100. You save maybe $100 monthly versus straight 4% renewal. 2 years left, blend to 3.18%. $2,950 monthly. You're saving $350 per month or $21,000 over 5 years. 3 years left, blend to 2.85, $2,800 monthly. That's $400 monthly savings or $24,000 over the term.
So the sweet spot is having 2 to 3 years remaining. What about someone with 4 years left? Should they even consider this?
4 years gets interesting. You might blend down to 2.6%, which is fantastic. But here's the catch. You're surrendering 4 years of sub 2% rates. If rates drop next year, you've locked yourself out. The calculation becomes, do you value certainty over potential savings? For risk-averse borrowers, even with 4 years left, blending provides peace of mind.
Let's talk about lender variability. You mentioned different banks calculate this differently. What should someone specifically ask their lender?
Ask 3 specific questions. 1, what is your exact blending formula? Are you using simple time weighting or something else? 2, will you provide a written calculation showing how you arrived at the blended rate? 3, are there any fees, penalties, or conditions attached to this blend? Some lenders charge administrative fees. Others require you to increase your mortgage balance slightly. Get everything documented.
What's a red flag that tells someone their lender is offering a poor blend?
If the blended rate is within 20 basis points of straight market rate, you're not getting real value. For example, if market rates are 4% and they offer you 3.85 with 2 years remaining on a low rate, that's essentially no blend at all. Walk away and try another lender or negotiate harder.
Can you negotiate the blend calculation itself, or is it take it or leave it?
You have negotiating power, especially if you have a large mortgage or multiple products with the bank. I've seen clients push back and get an additional 10 to 15 basis points shaved off. Say something like, your competitor offered me 3%. Can you match or beat that? But even if you don't have another offer, it creates pressure.
What about prepayment privileges during the new blended term? Do those change?
This is critical. When you sign a new 5-year term, you get fresh prepayment allowances, typically 10 to 20% annually. If you have cash flow, you should maximize these immediately. Pay down principal aggressively in years 1 and 2 while you're locked at your blended rate. This reduces your balance for the next renewal.
Let's talk about the cost of breaking versus blending. Give me a concrete example of the penalty savings.
Take a $500,000 mortgage with 3 years remaining at 1.6%. Market rates are 4%. The interest rate differential penalty to break early would be approximately $18,000. If you blend and extend instead, most lenders waive penalties entirely or charge a nominal $500 admin fee. You're saving $17,500 in penalties alone.
Are there situations where breaking and paying the penalty actually makes more sense than blending?
Yes, if another lender offers you a significantly better rate that offsets the penalty within 2 years, do the math. For instance, if your penalty is 15,000, but switching saves you 800 monthly, you break even in 19 months. Over 5 years, you're ahead. Also, if you need to increase your mortgage for renovations or debt consolidation, you can't blend. You have to refinance or switch.
What's the process timeline? If someone calls their lender today, how long until they have a blended rate locked in?
Most lenders can provide a blend calculation within 48 hours. Once you accept, the paperwork takes 1 to 2 weeks. The key is getting rate protection during that window. Ask them to hold the blended rate for at least 30 days while you review terms. If rates spike during processing, you want your original quote honored.
Can someone blend and extend more than once? If they blend now and rates drop significantly in 2 years, can they blend again?
Technically, yes, but each time you're resetting the term and the lender recalculates. If you blend today to 3% for 5 years, then want to blend again in year two, you'd have 3 years left at 3%. The new blend depends on where market rates are then. It's not a strategy to use repeatedly. It's typically a one-time move to navigate a specific rate environment.
What documentation do borrowers need to provide to get a blend approved?
Most lenders require minimal documentation if you're staying with them and not increasing the balance. They'll verify your income hasn't dropped dramatically and check your credit hasn't deteriorated. You're not going through full underwriting like a new mortgage. However, if you've changed jobs, taken on significant debt, or missed payments, they may decline the blend.
Final tactical question. What's the optimal time of year to execute a blend? Does timing within the rate cycle matter?
Watch bond market trends. If 5-year bond yields are rising week over week, mortgage rates will follow. Lock your blend before that happens. Conversely, if bond yields are falling, wait a few weeks. Mortgage rates might drop 10 to 15 basis points. Right now in late March 2026, with yields climbing, I'd act quickly rather than wait.
Sum up the action steps for someone listening who thinks this applies to them.
Step 1, calculate how much time remains on your current term. Step 2, call your lender today and request a blend and extend calculation. Step 3, get competing quotes from at least 2 other lenders to use as leverage. Step 4, compare the blended rate to straight market renewal rates. If you're saving at least 50 basis points, it's worth doing. Step 5, lock in the rate with written confirmation and execute within 30 days.
Mouli, this has been incredibly detailed. Thank you for breaking down the math and strategy behind blend and extend. To everyone listening, this is one of the most powerful tools available right now for managing your mortgage costs. Don't leave money on the table. Run the numbers and make an informed decision. This has been Your Mortgage Minute by onlendhub.ca. We'll see you next time.